You walk over to the sink, you turn that handle, and there it is. Clean, safe water. It's maybe the most fundamental thing we rely on, isn't it, every single day? And for most of us, certainly here in the U.S., you just don't give it a second thought. But behind that simple faucet turn, well, there's this absolutely enormous complex system. And yeah, it's facing some pretty big challenges, a lot of it totally hidden underground.
That's right. And when you start digging into the sheer scale of it all, the history, how it got built, and the pressures it's under now, you realize just how vital this sort of unseen network really is.
Absolutely. So that's what we're doing in this deep dive. We're going to unpack what's really going on with this essential service in the U.S. We'll dig into the sources you shared, industry reports talking about infrastructure problems, financial analyses looking at specific companies, perspectives from investors too, really trying to understand the huge investment that's needed. And then, okay, what does all this mean for the companies involved, specifically the publicly traded water utilities? We're focusing on American Water Works, that's AWK, and Essential Utilities, WTRG. People often call these defensive stocks. So we'll explore why and, see if the sources really back that up.
Yeah, and the material gives us a good mix. We've got stuff from the American Water Works Association, the AWWA, which is, basically the industry voice. They lay out the priorities, the headaches. Then there are financial breakdowns from places like Simply Wall Saint, Investor Place. They give us the hard numbers on the companies. And we even got a peek at investor sentiment from discussions on Reddit, specific points people are making. So it's a good combination. Lets us see the big picture infrastructure stuff and the company level details.
Okay, so let's start right at the beginning, the absolute core. Why is water just non-negotiable?
Well, because life just stops without it, doesn't it? Modern society, anyway. Millions of people depend on it daily for drinking, cooking, basic sanitation. I mean, it's public health 101. But also washing, cleaning, and critically firefighting. If the water stops, everything grinds to a halt, immediately.
And like you said, it's mostly hidden. We see the tap, maybe a fire hydrant, but not the miles and miles connecting it all.
Exactly. And that infrastructure, it's huge. And it didn't just appear overnight. It evolved. Think way back. Collecting water used to be a daily chore, right? Manual labor, sure. Early civilizations built aqueducts. Look at the Romans' amazing engineering to bring water into cities. But the system we know in the U.S., the pipes under the streets, water right to your house, that really started taking shape late 1800s.
What drove that change back then?
A few things came together. You had better materials, like durable cast iron pipes, finally making big underground networks feasible. Plus, reliable power sources emerged. That meant you could pump water efficiently, push it uphill over long distances, beat gravity. So that period, late 1800s into the early 20th century, that's when the foundations of our current urban water systems were really laid down. Then there was another huge expansion phase after World War II, with all the suburban growth.
Okay, so built in phases, mostly underground. Can you break down the key parts of this hidden network for us?
Sure. So water basically travels through three main stages, let's say. From the source, a river, a lake, an aquifer to your faucet. First stop, pumping stations.
Kind of the engine room, right?
You could say that. They do critical jobs. They pull the raw water from the source, which might be miles away. Then they push that raw water over to the treatment plants. And after it's treated, different pumping stations push the clean water out into the distribution network under pressure, making sure it gets everywhere. These stations are complex bits of kit, big pumps, lots of electricity needed, constant maintenance required.
Okay, so water's pumped from the source to treatment. What goes on there?
Treatment is where it's made safe. Safe to drink, safe for everything else. These facilities use a whole series of processes to remove contaminants. We're talking sediment, bacteria, viruses, chemicals, anything harmful. And they have to meet strict standards set by the EPA, the Environmental Protection Agency. Importantly, those standards evolve. They often get tighter as we learn more about potential health risks or new contaminants.
Like PFAS, the forever chemicals we hear about now.
Exactly like PFAS. Dealing with things like that requires really sophisticated and often very expensive treatment technologies. So treatment plants need skilled operators, specialized chemicals, and they constantly need upgrading to keep up with regulations and ensure water quality. They're designed for the specific water source and community, and they need to be adaptable.
Right. So raw water, pumped, treated. Then it enters that massive distribution system you mentioned.
And this is where the scale just blows you away. The distribution system is that huge web of underground pipes carrying the treated water from the plant to every single connection. Homes, businesses, fire hydrants, you name it. The sources we looked at estimate there are about 700,000 miles of these pipes across the U.S.
Hold on, 700,000 miles? How far is that, really?
Okay, perspective. That's more than 4 times the length of the entire U.S. national highway system, all those interstates. Yeah, think about managing that. Engineers use complex computer models to design these networks. They figure out pipe sizes, required pressure, needs to be reliable everywhere, right? And they need extra pressure, bigger pipes for things like fire hydrants. You'll also have booster pumps dotted around the network to keep the pressure up over long distances or changes in elevation.
And this whole thing serves, what, 240 million Americans? It's just this colossal invisible machine keeping modern life going.
It really is. And honestly, most of the time, it works so well we just don't notice it. Until, oh, something goes wrong.
Which brings us right to the main challenge, the one that screams out from all the industry reports. The system is old.
Critically old. In a lot of places, dangerously old. Like we said, big chunks of this network went in the ground in those main phases. Late 1800s, early 1900s, the 1920s, then again, post-WWII.
Right.
A lot of the pipes used back then, especially the cast iron ones, they were maybe designed to last, say, 50 to 75 years.
Okay, so a pipe laid in 1950, that's over 70 years old now. A pipe from 1920 is over a century old.
Exactly. So a huge portion of this network is operating way past its intended lifespan. That's the root cause of so many problems we're seeing today. It's fundamental.
What happens physically when these pipes get that old?
The main enemy is deterioration, specifically corrosion. Pipes corrode from the inside chemical reactions with the water itself, and they corrode from the outside interaction with the soil, groundwater around them. Over decades, this corrosion weakens the pipe material, makes it brittle. And as it gets weaker, it's much more likely to leak.
And leaks aren't just about lost water, are they? It's a two-way street.
That's the crucial point. Yes, a leak means treated, clean water is escaping, and that's waste. Expensive waste. But just as bad, maybe worse, a break or crack allows stuff from the outside contaminated groundwater soil bacteria to get into the pipe. That compromises water quality. Now, even the best-run modern systems have some unaccounted for water, a bit of seepage is expected, but in an old corroding network, the waste and the contamination risk just skyrocket.
And when it's not just a slow leak, but a big failure, a pipe burst, the disruption is immediate and messy.
Oh, yeah. A main break is a major headache. You often have to dig up streets, sometimes busy roads, even highways. Think traffic nightmares for days, weeks sometimes. Water service gets shut off for everyone in that area, temporary shutdowns. And then even when it's fixed, you often get boil water advisories because the pressure loss during the break could have sucked contaminants into the system.
And the costs, they must just pile up.
They absolutely do. You've got the cost of the actual pipe repair, then digging up the road, maybe repaving big sections, traffic management, detours, plus all the admin around issuing boil advisories, testing, lifting them. These aren't just minor inconveniences, they're expensive, time-consuming emergencies.
The sources had some really startling examples. Baltimore really stood out.
Yeah, Baltimore is sobering. Their old infrastructure means pipes burst about 1,000 times a year.
1,000 breaks a year.
Per year. Just imagine the constant cycle of disruption, repair crews, costs, and maybe even more shocking. They estimate they lose 20% of the water they draw from reservoirs every single day, just through leaks in the transmission system, before it even gets close to a customer.
20% loss daily.
Yeah.
Just gone.
Wow.
That number alone just frings the whole aging infrastructure problem, doesn't it?
It really does. And it's not unique. Look at Houston back in 2011. They had a severe heat wave and drought. At that point, 40% of their pipes were already past their operational life.
Yeah.
The stress from the drought and heat, it triggered 11,000 leaks. 11,000 in just 2 months. They ended up losing or unable to account for 25% of the city's entire water supply during that period.
Trying to manage a drought while losing a quarter of your water to leaks. It's almost unbelievable.
It makes a bad situation exponentially worse. And it's not just drinking water pipes either. The Miami example highlighted the wastewater side. Their old sewer system ruptured 65 times in 2 years, discharged something like 47 million gallons of raw, untreated sewage straight into waterways. The environmental damage, the public health risks, they go way beyond just the service being out.
Okay. So the system's old, failing, leaking water, letting contaminants in, causing expensive emergencies, which logically leads to the next huge challenge. Who pays to fix all this?
Exactly. And the price tag is, well, enormous. Way back in 2007, the EPA estimated $384.2 billion was needed over the following 20 years just for drinking water infrastructure replacement. And remember, that estimate itself is now, over 15 years old? The real number today is likely much higher.
And the AWWA's recent report showed this financial strain is still top of mind, maybe even worse now.
Absolutely. Their fall 2024 survey found that funding for capital improvements is now the #1 priority for the entire water sector. They estimate there's an annual gap of about $19 billion between what's actually needed for pipe replacement and meeting regulations versus what's actually being invested each year.
A $19 billion shortfall every year. And I guess that doesn't even cover things like future population growth or climate change adaptation.
Nope. That $19 billion annual gap is just to tread water, basically. Fixing the old stuff, meeting current rules. It doesn't include the extra investment needed for growth or for building resilience against climate impacts or for dealing with new regulations like PFAS.
So where does that burden fall? Who's supposed to come up with this money?
Mostly the public sector. Around 85% of the water in the U.S. is delivered by publicly owned utilities. That means cities, towns, local communities, state governments. They're on the hook. And the sources are pretty clear. The costs often just swamp their budgets. They don't have billions lying around for pipe replacement programs.
And rallying public support, political will for these huge, expensive projects must be tough, especially when the work is buried underground.
That's a massive hurdle. One source nailed it. These are low visibility activities. It's hard to get people excited or to justify big rate hikes for something they can't see. Like the source said, you can't easily go to a ribbon cutting in front of a new sewer line.
Right.
Even if a city invests billions, if the water was already flowing okay before, users might not even notice a difference. Makes the politics very tricky.
And it's not just the big replacement projects. Day-to-day operating costs are going up too, right? Adding more pressure.
Yeah, definitely. Running these systems isn't cheap, and costs are rising. Pumping water uses tons of electricity. Energy prices are a big factor. The cost of materials, new pipes, valves, pumps, that's gone up. Plus, running modern treatment plants is more complex, more expensive. Utilities also face costs for protecting water sources from pollution, securing their infrastructure from physical threats or cyber attacks. That's a growing concern. And in some places, finding and accessing new water sources as old ones get stressed, that adds another layer of expense.
Okay, aging pipes, massive funding gap. Then you've got these newer challenges hitting them too. Regulations, environmental stuff.
Right, these add whole new layers of complexity and cost. Take the EPA's new PFAS standards. Big deal. These chemicals need specialized, expensive treatment to get them out of the water. The sources estimated that just complying with the new PFAS drinking water rules could cost utilities $7.5 billion annually.
Wow, $7.5 billion a year just for PFAS on top of everything else.
Yeah. It shows how, as our understanding of contaminants evolves, the regulations follow, and that creates substantial new, ongoing costs for the sector.
And then layer climate change on top of all that.
Absolutely. Climate change hits water systems hard, and in different ways depending where you are. More extreme weather, bigger droughts, heavier floods, wildfires impacting watersheds, changing rain and snow patterns affecting supply. All this creates more stress, more variability. Droughts mean less water available. Floods can overwhelm systems, contaminate sources. It just increases the need for smarter water management. Maybe better irrigation, advanced filtration, maybe even things like water harvesting or desalination in some spots. All adds pressure, adds cost.
And the final piece of this difficult puzzle, affordability. If utility costs go up, rates go up, and that hits people's wallets.
Precisely. Water and wastewater bills have been rising faster than inflation, faster than incomes in many parts of the U.S. And that hits low-income households the hardest. For them, a central water service can become a real financial strain.
The numbers on that are worrying too.
They are. The sources mentioned about 20% of U.S. households are behind on their water bills. And maybe as many as 19 million households are struggling with water costs that are considered unaffordable, meaning it eats up too big a chunk of their income. So you see the picture, pipes are failing, not enough money to fix them, new costs from rules and climate change, and the whole thing becoming unaffordable for millions.
It really does sound like a perfect storm, but it can't be all bad news. The sources must talk about solutions, right? How the industry is trying to tackle this.
Yeah, they are. It's not just throwing hands up. On the infrastructure side, they're getting smarter. It's not always rip and replace for every pipe. There's a big focus on rehabilitation.
Rehabilitation, what does that mean in practice?
Well, instead of digging up a whole pipe, which is super expensive and disruptive, they might clean out the inside of a corroded pipe first, get rid of all the gunk and mineral buildup. Then they can apply a new lining inside the old pipe. Often it's like a cement mortar or a special epoxy resin. This lining basically creates a new, smooth surface inside the old pipe. Stops future corrosion, improves flow, can even add some strength back. Extends the pipe's life significantly, but usually costs less than a full replacement.
So like giving the old pipes a new lease on life from the inside out.
Pretty much. And technology helps too, things like acoustic monitoring. They use sensitive microphones to basically listen to the pipes, usually at night when it's quiet and water use is low. Tiny sound changes can pinpoint leaks, even small ones, and tell them exactly where they are. That lets them target repairs really efficiently instead of guessing or waiting for water to bubble up on the street.
But I guess sometimes the pipe is just too far gone. Replacement is the only option.
Oh, absolutely. If a pipe is structurally unsound, or if the area needs much higher capacity now, then yeah, you got to replace it. That's the most expensive, most disruptive option. When they do put in new pipes, they use modern materials, ductile iron, PVC, and techniques to make them last longer. That includes things like factory-applied linings inside, treating the water chemistry so it's less corrosive. And for metal pipes, wrapping them in plastic sheeting before burial to protect against aggressive soils.
Okay, so better engineering, better tech. But even with that, fixing or replacing 700,000 miles of pipe, it's still a gigantic, costly job, which brings us back to the money, funding solutions.
Right. And this is maybe the most critical piece of the puzzle for the whole sector. Since most systems are public, getting the money means, realistically, a mix of government help, adjusting rates, and increasingly finding ways to bring in private investment.
What government support is out there?
Well, the main federal workhorse for decades has been the State Revolving Fund Program, the SRF. Basically, the feds give low-interest loans to states, and the states then loan that money out to communities for water and wastewater projects. It's crucial. More recently, there have been big sloods of funding from things like the American Recovery and Reinvestment Act, ARA, back in '09, and significantly, the bipartisan infrastructure law, the IIJ, passed in 2021.
Right. ARA was the post-recession stimulus. IIJ is the big recent infrastructure bill.
Correct. ARA pumped billions into the SRF specifically, with some earmarked for green projects.
Yeah.
And the IIJA, that's the single largest investment in water infrastructure in U.S. history. Tens of billions over 5 years, boosting the SRFs and other programs. This federal money is absolutely vital for towns and cities that just couldn't afford these huge projects otherwise.
And then there are rate increases, which utilities use, but that's obviously sensitive for customers.
Yes, regulated rate adjustments are the standard tool. Utilities make their case to state regulatory commissions. Here's what we need to invest. Here are our costs. Here. If the commission approves, rates go up to help pay for it. But like we said, that directly impacts affordability. It's a constant balancing act.
The sources also really leaned into the potential for attracting more private money. Why is that seen as so important now?
Because the need is just so vast. That $19 billion annual gap we talked about, public funds and rate hikes alone probably can't close it. Meanwhile, you've got big private investors, infrastructure funds, pension funds, looking for stable, long-term places to put their money. Water utilities, being essential services, often monopolies, look really attractive from that perspective, predictable returns. So bringing in more private capital could be key to actually getting the work done on the scale needed.
Are there roadblocks to getting more private money in?
Yeah, one big one mentioned is around private activity bonds, or PAYBs. These are basically tax-exempt bonds that governments can issue for private companies doing qualified projects, like infrastructure. But there's a limit, a volume cap, in each state on how many PAYBs can be issued each year across all types of projects. Water projects currently have to compete with housing, transportation, etc. for that limited PAYB capacity in most states.
So it limits the amount of tax-advantaged financing available specifically for private water investment.
Exactly. There's proposed legislation, H.R. 1802 was mentioned, that would take water and wastewater projects out of those state volume caps. The idea is if water doesn't have to compete for that limited pool, it'll be easier and more attractive for private companies to finance and invest in upgrading these systems using PAYBs.
And what about public-private partnerships, P3s?
P3s are definitely seen as a major tool going forward, probably increasingly critical. This is where a city or town partners with a private company. The private partner might design, build, finance, operate, maintain the system, or some combination. The city usually still owns the assets, but the private partner brings the cash, the technical know-how, maybe operational efficiencies the public side lacks. It lets communities tackle huge projects they couldn't handle alone by leveraging private resources and expertise.
And we see the big players, like American Waterworks, already heavily involved in this kind of investment.
Oh yeah, their sheer size allows them to deploy serious capital. One source mentioned American Water spent around $1.5 billion on infrastructure upgrades across 15 states in just the 3 years before the source was written. That kind of large-scale, consistent investment is exactly what's needed to chip away at that mountain of aging infrastructure.
The AWK reports really seem to hammer home the industry's focus here.
They do. I mean, the fact that capital funding shot up to the #1 priority in their survey, that says it all. And only 41% of utilities felt they could fully cover all their costs just through their current rates and fees. 41%. That highlights the huge reliance on external funding, whether it's government grants, loans, or rate increases.
But despite all these funding pressures, the industry is trying to look ahead, invest in the future.
Yes, definitely. The report suggests that investments in things like new treatment tech, especially for PFAS, and also green solutions for climate resilience, those investments are actually expected to double in the next 1-3 years. So even with tight budgets, there's a clear recognition they have to tackle these future challenges, invest in the right tech.
And they're pushing policymakers, too, advocating.
That's right. Events like Water Week are big for advocacy. The industry is pushing Congress hard. Things like reauthorizing the IIJA funding so it continues past the initial 5 years. That's huge. They're also pushing for source control and polluter pays approaches for PFAS, basically saying the companies that made the mess should help pay to clean it up, not just ratepayers. And really importantly, advocating for a permanent federal program to help low-income households afford their water bills. Address that affordability crisis head-on.
Okay, so massive problems, complex system, but also active work on technical, financial, and policy solutions, which sets us up nicely to pivot to the investment angle. Given all these costs, all these challenges, why are stocks like AWK and WTRG often seen as defensive? What makes them supposedly safe havens?
It really boils down to the service itself. It's absolutely essential, non-negotiable. Demand for water is incredibly stable. It just doesn't really change much whether the economy is booming or busting. Think about it. In a recession, you might put off buying a new car, skip vacations, eat out less, but you have to use water. Drinking, cooking, flushing.
Demand is inelastic, as economists say.
Exactly. That provides a bedrock of revenue stability that most other industries just dream about, which makes them look attractive when the economy feels shaky or markets are volatile, hence defensive.
And the fact they often operate as local monopolies helps too?
In most places, yeah. You don't get to shop around for your water provider.
Yeah.
Now, they are regulated, which caps their profits, but that lack of direct competition in their service territories also adds to the predictability of their revenue.
And that stability sometimes shows up in the stock performance.
The sources suggested so. WTRG, for example, was mentioned as having relatively stable share price performance compared to the wider market, especially during rocky periods. That's the defensive characteristic playing out.
Plus, their revenue is underpinned by those regulated rate structures.
Yes. While regulation limits upside, it's also designed to provide downside protection. Utilities can go to their state commissions and make a case for rate increases to cover necessary investments and operating costs. The system is generally set up to allow them to earn a reasonable return on their investments over time. One source mentioned WTRG specifically uses things like weather normalization mechanisms, which help smooth out revenues even if unusual weather affects water usage temporarily.
Okay, let's zoom in on American Waterworks, AWK. What did the sources highlight about them?
Well, first, scale. AWK is consistently described as the biggest investor-owned water utility in the U.S. Huge footprint across many states.
And they're planning to spend big on fixing those infrastructure problems we discussed.
Very big. Their plans call for investing something like $16 to $17 billion in capital over the next 5 years alone. That's directly targeted at upgrading systems, replacing pipes, improving treatment, addressing all those core challenges across their network.
And that spending is expected to fuel growth.
That's the plan. They've guided for annual earnings per share growth, EPS growth of 7% to 9%. How? By putting that capital investment into their rate base, the value of their assets. Regulators allow them to earn a return on that rate base, so bigger investments, if approved, lead to higher potential earnings and justify rate requests.
The Reddit discussion gave some interesting color on how individual investors see AWK.
Yeah, that was useful ground-level perspective. One person commented they thought AWK was trading near its fair value, saw it as pretty low risk. Their positive view was tied directly to all that necessary infrastructure spending. They saw it as a guaranteed growth driver the system has to be fixed, and AWK is positioned to do it. They also pointed to AWK's history of consistent dividend growth, estimating it around 8–10% a year.
So that combo growth, fueled by essential spending, plus a reliable growing dividend, that sounds like the classic utility investment appeal, right? Stability plus income growth.
It definitely positions AWK as a direct play on that massive, unavoidable need to modernize critical water infrastructure. That gives it a certain predictability.
Okay, let's switch gears to essential utilities, WTRG. Their business is a bit different.
Slightly, yeah. WTRG isn't just water and wastewater. They also operate regulated natural gas utilities. So it's a bit more diversified as a utility, though water is still a very big part of their business.
And they've got hefty investment plans, too.
They do. Planned capital spending is $7.2 billion for the 2024-2028 period, again, focused on system upgrades. What's also interesting with WTRG is their stated plan to potentially acquire smaller water and wastewater companies. The water sector is still pretty fragmented, lots of small municipal systems. Companies like WTRG see opportunity to buy these up, bring in capital, improve efficiency. That consolidation is another growth avenue for them.
Looking at the financials from Simply Wallsaint and InvestaPlace, anything jump out for WTRG?
Well, one source noted its forward PE ratio, price to earnings, was around 18.8 at the time, which they saw as reasonably attractive. It also offers a decent dividend yield, quoted in the range of 3.29% to 3.42%, solid income potential.
Their past earnings growth looked pretty impressive.
It did, yeah. Reported at 14.4% over the previous 5 years. That's strong. Although the analyst forecasts were for future growth to moderate a bit, down to around 6.24% per year. Still respectable for utility, mind you, but maybe suggesting that super high past growth had some specific drivers, like maybe past acquisitions or big rate cases.
And there was a mention of it potentially being undervalued based on analyst targets.
Yes, the Simply Wallsaint piece cited an analyst consensus target price of US $45.33 when the stock was trading around US $38.10. So their model suggested some potential upside at that point.
But crucially, the sources didn't ignore the risks. There were some specific flags raised for WTRG.
Right, important balance. One concern highlighted was interest coverage. Basically, are their earnings comfortably covering the interest payments on their debt? The source suggested maybe not comfortably covered, meaning a larger slice of earnings is going just to pay interest. If earning a dip, that could become tight.
And the dividend coverage was another point.
Yes. A related point was whether the dividend payment was well covered by free cash flow. Free cash flow is the cash left after paying operating costs and capital expenditures, the money spent on infrastructure. If your dividend payout is higher than your free cash flow, it raises questions about sustainability. Are you borrowing to pay the dividend? Using cash reserves. Not ideal long-term. That's a key metric for dividend investors.
And their debt level, the debt-to-equity ratio, was flagged as potentially high risk.
Yeah, a ratio of 120.2% was mentioned. Now, utilities inherently carry more debt than many sectors because their revenues are stable. But a level seen as too high increases financial risk. It can make future borrowing more expensive and just reduces financial flexibility, especially if interest rates are rising.
So for WTRG, you've got clear growth drivers, the investment plan, potential acquisitions, rate adjustments, maybe even benefits from PFAS roles requiring upgrades. But you also have these financial risks around debt and coverage ratios to keep an eye on.
Exactly. It's about weighing those growth opportunities against the balance sheet structure and the coverage metrics. A classic investment trade-off.
The Reddit chat also sort of widened the lens a bit, didn't it, beyond just AWK and WTRG?
It did. It showed people thinking about the water theme more broadly. Some were looking at water technology companies, firms focused on purification, conservation tech, leak detection, that sort of thing. Others mention water ETFs like PHO or FIW as a way to get diversified exposure across the whole sector, not just picking individual utilities. And some even talked about companies involved in desalination, especially thinking about water scarcity in certain regions, different ways to play the theme.
And that little tidbit about Michael Burry from The Big Short fame, reportedly investing heavily in water after the financial crisis. That adds an interesting long-term perspective, doesn't it?
It really does. It's just looking at water not just as a stable utility, but as a fundamentally valuable, potentially increasingly scarce resource, driven by population growth, climate change, and exactly these infrastructure problems we've been talking about. That kind of macro, long-term view ties right back into why this sector needs so much investment and why clean water is becoming more costly and complex to deliver.
Okay, so let's try to bundle the key risks together that emerged from all the sources. You've got concerns about debt levels, maybe particularly for WTRG based on the metrics cited. Related challenges with dividend coverage from free cash flow also flagged for WTRG. Then there's the massive nationwide cost of fixing the infrastructure, a challenge for all utilities in the space. Potential regulatory hurdles, delays in rate cases, unexpected new rules adding costs. And that looming risk of affordability if costs keep rising, can ratepayers actually bear it? Could that lead to pushback, collection problems?
Those are definitely the big operational and financial headwinds. They're real, but again, they exist within the context of providing a service that society absolutely cannot function without.
Right. Okay, let's try and crystallize this. The key takeaway from this deep dive into U.S. water utilities. What's the core lesson?
I think the fundamental point is that the system delivering our water is under enormous strain. It's old, it needs staggering amounts of investment, funding is a huge challenge, especially for municipalities, and it's facing new pressures from regulations like PFAS and from climate change impacts.
But paradoxically, perhaps, these huge societal problems create a very predictable, necessary environment for long-term investment, and companies like American Water Works and Essential Utilities sit right in the middle of that.
Exactly. Because the service is essential, demand is stable. And while the regulatory system controls their profits, it's also generally designed to allow them to recover the costs of necessary investments over time through rates. That framework supports the stable revenues and earnings that make them attractive defensive plays, particularly when the economy feels uncertain.
So the investment case isn't really about explosive growth or disruptive tech. It's fundamentally driven by the unavoidable need to maintain and upgrade this critical aging system. The problem itself fuels the business opportunity.
You could put it that way. It's a sector where fixing a massive societal problem, ensuring clean, reliable water, is directly linked to the business model and the investment thesis. Of course, it operates within that complex world of huge capital needs and regulatory oversight, but it's fundamentally a long-term bet on an absolute necessity.
Which leaves us with a final thought to chew on. Given this absolute human need for clean water, given the rising costs and complexities of providing it, the old pipes, the climate stress, the new contaminants, and given the sheer scale of investment required, how might the basic value, the public perception, maybe even the strategic importance of water itself and the companies delivering it, how might that fundamentally change in the years and decades ahead?
That's a big question, one that could really shape both investment decisions and public policy for a long time to come.
That's our deep dive for today.